Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1228A, and today's date is March 14th, 2017, and the title of the episode is U.S. Government Down to its Last $66 Billion, which will only last until Memorial Day. Now, before I get started, I just want to make an announcement. I uploaded an interview with Andy Hoffman. It is on the X22 Report Spotlight YouTube channel. So if you go to YouTube and you type in X22 Report Spotlight, it'll bring you right to the video. Or you can come over to the X22Report.com site, scroll down a little bit, you'll see it on the right-hand side. You can play the video there. Or you can go to newssentinel.com. Same thing, scroll down a little bit, look over to your right-hand side. You'll see the video there, and you can play it right on the site. Let's get into the economic collapse financial news. Now, out in the UK, it looks like Theresa May, well, she got the green light, and it looks like she got approval to start the Brexit process, and she's allowed to invoke Article 50. And we can see right now that many believe that she's going to be doing it maybe this week, but it looks like she might put it off to the end of March. And we see that many other countries, they are looking at what is happening right now because they want to do the exact same thing. We see Marine Le Pen. She said if she wins, they're following in the footsteps of the UK. We're going to get rid of the EU. We're going to hold a referendum. We're going to create a new franc. And at this point, the EU is doomed because it's not just these two countries. It's the rest of Europe that is looking at the situation saying, okay, if those two are out, guess what? We're not going to stay in because it makes no sense for us to stay in. And we can see many countries would like to go back to their own currency. Many countries would like to take control of their own borders. And right now, we can see that the EU, their days are numbered right now. And we can see that whole entire system is going to be falling apart. Now, we have a lot of things that are happening all at once. Because if the EU starts to decline and go down, as more and more countries leave, it's going to affect the rest of the world because everything is interconnected. The banks in the US are interconnected with the EU. And we're going to have a major problem. Now, when Trump was running during the election, a little bit after the election, we saw everything rising. Everything looked fantastic. And they were saying it's Trumphoria. And now, after that dead cat bounce of everything moving up, everything's starting to roll over all of a sudden. And we're starting to see that business confidence right now, well, it has declined. And Gallup's latest weekly economic confidence reading, it found that Americans' confidence in the economy returned to its recent levels last week after a record-setting post-recession high the week before. Gallup's U.S. Economic Confidence Index was plus 9 for the week ending March 12th. This is down from plus 16 from the previous week. And we can see already, when asked, 48% of Americans say the economy is getting better, 45% say it's getting worse. That compares with 54% that say the economy was getting better and 39% saying it is getting worse. People are starting to realize, okay, the Trumphoria is over right now. The market keeps going up, but nothing has changed in the economy whatsoever. Everything is exactly the same. Actually, it's deteriorating even faster because we can see retail contracting, GDP is completely manipulated, unemployment is completely manipulated. They're still putting out the manipulated numbers. We see inflation moving up right now. PPI final demand surged by 2.2% year on year, driven by a 4% year on year jump in final demand goods. This is the highest inflationary print since March of 2012. And we see inflation is rising in the US. We see it's rising in Spain, rising in Germany, and it continually moves higher and higher. And eventually what's going to happen is the Fed is going to lose control of this. I mean, we've seen inflation in many other areas. Food, we've seen food go up. We've seen the cost of college go up. Housing, those are in a bubble, but we do see inflation there. We see insurance premiums. Those are skyrocketing. And eventually what's going to happen is it's going to hit in every single sector. And we're going to see inflation everywhere. And it's going to hit much harder. Now, alarm bells are starting to ring across multiple asset classes as we approach the Fed's first double rate hike in 3 months since 2006. And the most concerning is the credit markets. We know the credit impulse was below zero in the negative range. We know China has been pushing the credit market up. And China right now, well, they're seeing slower growth at this point. Robert Shiller is out there saying that the stock market well, it's starting to look like it's 2000. And he's saying it's the end of the bull market. Shiller says when the markets are buoyant, as they are now, resisting the urge to pile in is hard regardless of what else might be happening in society. One factor that makes him very cautious on American shares is the S&P 500 cyclically adjusted price-earnings ratio. While the metric is still about 30% below its high in 2000, it shows stocks are almost as expensive now as they were on the eve of the 1929 crash. And we can see during the dot-com bubble, stocks were very expensive. So to sum up what Mr. Shiller is saying, the market is way overpriced. It's not as intellectual as people would think or as an economist would have you believe. And he believes that it's coming down. Many people do. Many people see that the stock market, it has reached its height. Maybe it'll move up just a little bit more, but we see the smart money starting to move out of the market and the retail investors to move in. We also see that corporations, they're slowing their purchases of stock at this point. Now, they haven't stopped completely, but you can see the pace. They are definitely slowing. Now, just before I mentioned that China, they are suffering the worst start to a year for retail sales since 2002. And with its credit impulse wearing off and inflation spikes stalling any hopes of renewed stimulus anytime soon, it appears that China's always happy consumer is not so happy in the beginning of 2017. And this is going to have a ripple effect throughout the world. Now, against expectations of about 10.6 year-over-year gain in a year-to-date cumulative retail sales, February, well, it dropped down to 9.5%. And again, this is weak. And we can see right now that the growth of China is slowing. And this is going to be a major problem. Now, right now, we know the U.S. economy is weak. It's very weak. But the Federal Reserve is planning to raise interest rates anyway into a weak economy. Now, we know what happened in 1937. It didn't end well. And according to the Atlanta Fed, the U.S. economy is expected to grow at around 2.8%. Then they revised it down. Now they're down to 1.2%. So the economy is not doing as well as everyone thinks. And this isn't the kind of environment where the Fed typically raises rates. So why is the Fed raising rates when the economy is crawling along at suboptimal speed and perhaps headed for a recession? I think we're already in a recession because we're already seeing indicators and signs that show us that we're already in this recession. Well, the Trump bump has been the biggest post-election day rally in Wall Street history, and the promise of giant tax cuts, fewer regulations, and $1 trillion in fiscal stimulus, well, has sparked a stock buying frenzy that added nearly 2,000 points to the Dow. And we can see right now that Wall Street, well, they're hoping that it continues. And the market loves Trump. The unexpected stock surge has thrown a wrench in the Fed's plan to gradually guide stocks higher, avoiding a bond market blowout that could send yields into the nosebleed section, wiping out trillions of dollars in equity in the process. Now, the Fed would rather avoid that type of scenario. And this is why the Fed is expected to gradually raise rates to dampen the irrational exuberance that has overtaken Wall Street right now. They're trying to control it a little bit because they know what will happen right off the bat. And who would be responsible? Well, the central bank. Because again, Trump hasn't done anything yet. So the Fed has repeatedly expressed uneasiness about the president's $1 trillion fiscal stimulus strategy, a plan that Yellen thinks could result in a sudden blip of activity that could push up inflation and overheat the economy. Now, a series of rate hikes will not only put the kibosh on Trump's chances for success, it will also undercut prospects for stronger growth. But why would Yellen want to foil a plan that would result in stronger growth and help the American people and bring jobs back? It's because stronger growth means higher yields on long-term debt. In other words, Yellen's buddies in the bond market will get absolutely pulverized if GDP picks up and Trump achieves his goal of 4% growth, which he's never going to reach. He's not even going to come close because we could see already the first quarter is at 1.2%. And most of the manufacturing jobs and other jobs are offshored. And we don't have the infrastructure right now to bring them all back. It all has to be built. And even with a $1 trillion plan, it's not going to work. And another thing, the Fed will not let it happen anyhow. So we see that we're moving towards this period of time where Trump wants to do all these things. And tomorrow, March 15th, we have the debt ceiling problem. And all of a sudden, we have major problems in this country. Not right off the bat, but going forward, if nothing is done with the debt ceiling, well, it's going to ramp up pretty darn fast. Now, David Stockman has said that the U.S. Treasury has funds of about $435 billion of cash. And that was because the individuals in government, well, they were piling it on because they thought Hillary Clinton would be in office and she would have to kind of convince Congress to raise the debt ceiling. But now we have Trump in office, and the U.S. Treasury's cash hoard, well, it kind of disappeared. They spent all the money. The daily Treasury statements for March 7th, the cash balance was down to $88 billion, meaning $347 billion of cash has flown out the door since October 24th. And on March 8th alone, the Treasury consumed another $22 billion of cash, bringing the balance down to $66 billion. During that 47-day period, the Treasury took the opportunity to pay down $57 billion of maturing Treasury bills and notes by tapping its cash hoard. They drained the $294 billion from the bank account of the Treasury, or about $6.4 billion per day. And here we are at March 15th already. And the Treasury will be out of cash by Memorial Day. That means there'll not even be a glimmer of hope for any type of tax stimulus, economic rebound. It means they're going to have to raise the debt ceiling or the country defaults. So we can see where we are headed right now. We're at a crossroads. Do they kick the can down the street and add more debt, which eventually is going to hurt us even further? Or do they take the pain now and say, you know something, we need to default? What is happening now is not working. Now, Trump has done this before with businesses, and he knows how far he can take it until he says, okay, enough's enough. We just can't go on. We know tax receipts are continually falling. More and more individuals are losing work. Jobs really haven't been created. We're under the manipulation of the BLS under Obama. We're not even looking at the real numbers. We will know because they're going to have arguments, discussions going past March 15th, going into maybe April. I'd be shocked if they just say, okay, let's just raise it. I mean, during the campaign, Trump was very angry at Congress for increasing the debt level. We'll have to see what he does now. So we're at a point right now where things are rapidly accelerating. We have individuals like Stockman, I just mentioned, Cliff High, Charles Nenner, Harry Dent, Bank of America, Citibank, JP Morgan, all pretty much saying the same thing, that things are going to rapidly change this summer going into the fall, where the entire system might come to a screeching halt. And if the debt ceiling is raised, we still have a problem because the world growth, it's declining. The credit impulse is below zero. China can't sustain all of this. We know that Japan, the EU, they're going to be tapering QE. So when we put all of this together, we can either take the pain now or we can wait a couple more months, but we're going to take the pain no matter what. There's no way to escape this at this point. And this is why everyone needs to get prepared and ready for what is coming. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.